Hi there, I'm Mark Sebastian, founder of OptionPit.com, and this is Volatility and Earnings, the Option Pit Method, how to use volatility to analyze and trade earnings. I'd like to remind everybody this is for educational purposes only. No, this should be considered investment advice, and options do have risk. For those of you who don't know me, that is me talking to my friend Liz Clayman. She's awesome, and I enjoy doing that kind of analysis and doing some network stuff. Option Pit, we are the best education company, kind of trading education company for option traders out there, bar none. We are traders who teach. We are not educators. So in addition to that, I am running a hedge fund in the middle of launching a second fund. So lots of funness there. Funness with fundedness, if you will. And my fund is called Carmen Line Capital. If you're a high net worth individual and qualified, you can always ask me about that. But today we're here to talk about earnings and how to trade it and how to make money trading earnings. So volatility can act like a headwind or a tailwind to successful trading. So we're going to talk about basic buy-sell decision, how to analyze expected stock movement, how to build a trade around earnings flies, and I'll kind of tell you what I really think of earnings and some better ways to trade. So has this happened to you? Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, and I'm not making money. The market maker stole my money. And the answer is no one stole your money. Volatility changed after earnings came out. And that is a very important thing to be aware of, is that volatility really does dictate earnings performance. So that's kind of the key. So let me talk about volatility really fast, just a quick rundown. Three main types of volatility I look at: realized, historical, and implied. Realized and historical can be used interchangeably. I'll kind of explain the difference, but each one is really useful in their own way. So realized vol is how much a product is moving right now. It's the daily move, the immediate move. While all moves end up being historical in nature, what has happened the day of and the previous few days might be considered realized volatility on a relative sense. You know, that's kind of the big difference. And so one way I look at realized volatility is to look at 10-day HV. So, and these are older charts, but these are all the same. So this is Goog from last, a quarter ago, and you can kind of see how much it was moving around. So if I pull up Google now, get that out of the way. If I pull up Google now, you can see how much it moved. This is the last 10 days, it's moved 27%. That's a nasty move. And you get a much better feel for what just happened, right? I can tell you that something important really happened in Google relative to the last 6 months. Certainly the last 3. What was going on here that I got movement, but I wasn't getting it here, here. And what does this mean? So that's really what I'm using for realized volatility, is kind of what's happening right now and why. So then you've got historical volatility. Historical volatility is how much of an underlying has moved in the past. And we're talking bigger chunks. So 20 days, 60 days, the year, long term, how much do things move? Those are really the keys there. Those are really the key. And, I can look at in monthly increments or yearly. It really doesn't matter. I can look at them in kind of however I want, as long as I'm spending enough time kind of really analyzing things, looking at what's going on. So, you can see here's a chart of Goldman, and you can get a view of, so like this 10-day, the white line is 10-day. That's going to be what I'll use for realized. The blue line is 20-day, and that's kind of how much it's moved over the last month. So at this point in time, Goldman had moved about 20% over the last month. And then this dark blue line is 60-day, and that really tells you what the recent trend is. Recent trend up, recent trend down, things like that. And that's really what it's about. Implied volatility. So implied volatility measures how much the market is expecting the underlying to move. It's based on the price of the options. And it is an output of the model, not an input. Now, I've got tons and tons and tons of stuff on implied volatility. All right. And so I'm not going to spend a ton of time, but the difference between HV, RV, and implied vol, IV, is that implied volatility is the only one that tries to be forward-looking. The rest are really backward-looking. There are all sorts of ways to use it. I can use live vol, Metastock, Bloomberg, you name it. But the key is it's an output of the pricing model. So here is VXGS. That's the VIX of Goldman Sachs. I can pull up a more recent one here. And you can see it's been a mover. Now, if I want to add a moving average, if I want to really get a really good view of what this looks like, there's the moving average. The one-day moving average. This is the stock chart of it in green. But you can see it makes some wild moves. But let me add I'm going to add another moving average. I'm going to add like the 200-day moving average. Or I'll add the 300-day moving average. Or I guess 400. And I'll make that dark blue. Super thick. Are you ready? Look at that. Hardly moves. So the big thing is that over the long term, we know where the volatility of a stock or index is going to go. It will revert to its mean. We do not know where the stock price is going to go. So again, here's Goldman. Kind of nonsensical, right? If I pull up a chart of Goldman now, doesn't really appear to make a lot of sense. Certainly isn't mean reversion like we have in my other in VXGS. So take a look at that. I mean, that is smooth as a pancake. Mean reversion. So that's the key. Stock can go anywhere and stay there. Volatility can go somewhere, but it doesn't stay. So that'll help us with our buy-sell decisions. So now when it's cheap, we buy. When it's expensive, we sell. So now let's talk about strike selection. All right, when I think IV is going to go up, I buy what it's called a soft delta. You can think of a soft delta as an option that is out of the money. All right, you can think about it that way. When I think volatility is going to be stable or maybe even go down, I'll use a hard delta. So hard deltas are going to be kind of in the money or slightly in the money, or even an at the money, its price can change, but that delta is going to be pretty firm. If I buy an at the money option, its delta is not moving. So it's really these out of the money options that are soft. So let's take a look. Hard is going to be resistant to change in volatility. Soft, if vol drops, you're going to lose delta. That's what happens with those out of the money calls when things don't move as much as we expect. So understand the difference. Here's Apple. All right, so this is Apple right before earnings. Take a look. Trading 99.99.99. This was just a good example. So take a look. And yes, I realize that it's wide down here, but we'll say that's 450 for the 102s, and my Jan and my 94s are going to be 80 cents. So now the next day we get that $6 move. Right? 99.99. Now 93.42. Not so hot. So I made 50 cents. So let's say if I paid $4.50 versus 80 cents, that would be I could have bought, let's say, 5 of the Jan 94s or 1 of the Jan 102s. We'll take a look. These are now we'll call it 860, 870. And these are 60 cents. These are up about 60 cents. These are going to be up about $4, $4.50. We'll say $4.25. So my 102s are up $4.20. And my 94s are up 60 cents. Well, what's 60 times 4? What's 60 cents times 4? $2.40. So let's say I went crazy and I bought 5 of them. Oh, I said 5. 5 would be $3. That'd be $4 I spent. Let's say I spent even more. I spent $4.80 on these puts. I bought 6 of them. What's 6 times 60? $3.60. Meanwhile, if I bought one of these options for $4.50, I made $4.30. What was the better trade? Buying one of the 102s or buying a bunch of the 94s? Correct. Do you guys know how rarely buying this option before earnings to express a directional opinion works? This option, the out of the money option, to express a directional opinion before earnings stinks. Someone said you also pay more commission with the 94. If you are trading, I don't want you to ever think about commission. It'll make a big difference in your trading. You'll be better at it. You'll be a better trader if you don't worry about it. So the Apple moved beyond where the market was expecting. All right, so let's take a look. It's trading 99.99. All right, so that's basically 100. All right, so if the market thinks 295 and 285. What is 285 plus 295? $5.80. So the market is expecting a $5.80 move. Well, it moved 650. We got a much bigger move. Much bigger move. All right. So the in the money was the way better trade. All right. So now the key is that out-of-the-money options tend to get completely overbought in earnings, and they tend to just get jacked up. It is almost never pays to own an out-of-the-money option ahead of earnings unless you're doing it as part of a spread. So let's take a look here. So the key to understanding earnings is to understand that straddle price. A straddle is the market's best guess at how much the underlying might move between now and expiration. It's about 80% of a standard deviation. The at-the-money straddle price of the weekly option, so the week of earnings. So like right now, the at-the-money option so if I pull up Google from last week, or even better, it'll be Microsoft. So if I pull up a chart of Microsoft from last week, I can actually get a look at how much what the market was looking for. Microsoft 78.75. The OCT 27, 78.5. 79, strangle, kind of best represents what Microsoft was looking for. So that's 130 and 125. $2.55 was what the market was looking for out of Microsoft, plus we'll call it the 25 cents. So we'll call it $2.80 was what the market was expecting. We moved 5. So that is kind of how straddles work. They're rarely dead on. In fact, they're usually overpriced. Straddles tend to generally be overpriced, but when they're wrong, guess what? Do they tend to be wrong by a little or wrong by a lot? What do you think? A lot, right? So you've got they're too expensive, they're usually too expensive by a little, and when they're too cheap by a lot. And so thus over time, that straddle price tends to be a pretty good guess. It's pretty accurate. So here's that weekly straddle. You know, in this case it was underpriced, but it did a decent job, right? It was a little under $6, and Apple moved $6.60 in this case. Like I said, it tends to be really wrong sometimes. All right, so now let's talk about earnings analysis. So in this case, the at-the-money straddle was expecting about a $5.90 move with the stock trading around 100. That's 5.9%. Knowing this can be valuable. All right. The next step is to look at historical moves. Is that expensive or cheap? Now, here is rule number 1 for earnings trades. If you're going to buy options, all right, if you're going to buy options, never buy an option that is outside of the earnings straddle. All right. So if Apple's looking for a $6 move, I will buy the 95 put or the 105 call, and calls inside of that and puts inside of that. So a $10 range, but never outside of that if I'm setting up a trade. Here's a chart of Tesla. How did this straddle last week work out in Amazon? It was about $40, and Amazon moved like 70. So not great. So here's Tesla at the time. I don't know why that's in there. I'll be honest. I think I changed some slides and that got dry. I think that was supposed to be a chart of Intel. So now, directionally playing earnings. I'm going to talk about how to actually set up directional plays. The key is to use soft deltas for your advantage. Remember I talked about those things get way overpriced. So let's take a look at Intel. All right. Now, when I wrote this, Intel had not had earnings yet. All right. So now we know. But Intel is in earnings week or into next week, and the use of the spreads is key when playing earnings directionally. It takes advantage of the volatility in stop deltas and keeps the delta hard. So take a look here. All right. And what I want you to know is take a look at see this IV number here? What happens as we go up? So I think Intel is going to rally. What happens as we go up in here? What happens to these IVs? They're flattish to going higher. Same thing on the downside. They get more and more expensive. Now Intel at 41.35, 65 cents, and we'll say 75 cents. Looking for about $1.30 move from 41.35. So they're thinking it could get to 42.65. What if I bought? So my two options, I can buy the 42 calls for 60, or I can do the 42.44 call spread for about 35 cents. That 60 is wrong. So, let's say 55 and a dime. So in this case, 45. So let's take a look. Here's Intel after earnings. You can see kind of how things worked. My 42 calls, so you can see it's 44.40. My 42 calls that I bought for, then we got a big move. So let's say I bought these for 50. They made $1.90. Not bad. That's not bad at all. I made almost 4 to 1. Meanwhile, my 2-point vertical for 40 is, let's say, 250, and my 44s are 40 cents. So, or 240. So I made about, so 240 minus 40, it's $2. Minus my 35 cents or 40 cents, let's say 40, that's $1.60. So I made 4 to 1 on my money, just like I did on my outright calls, and I risked less dollars. There was a lot of that type of trading. All right, so let's take a look here. There are a lot of cases where buying the spread works better than than not. Especially in the cases where the underlying doesn't go insanely crazy. So, what are some names? Let's like ExxonMobil. This was one. All right, that was kind of interesting. All right, day before earnings, trading 83.70. I think oil's up. Let's take a look here. We're trading 83.50. My goodness. Well, clearly this one doesn't have spreads. Oh, this is the day after. I'm sorry. I wanted this day. Here we go. Here we are. So we're trading 83.47. I can buy the 84 calls for 35 cents, or I can buy the 83.5, 85 call spread for about 45 cents. So I'm doing a 1.5 point vertical 45, or I can do the 84s for 35. What's the better trade? Well, they both lost, But my 83.5s were a lot better. And actually, I had a chance, when this was at 83.95, I probably had a chance to get out for a profit. Does that make sense? All right. So I hate Intel. How would I set up a bear play? I would use puts or put spreads or risk reversal. Generally speaking, I'd rather own a put spread. Why? Take a look here. You know, I can buy the 41 put for 65 and sell the 39 put at 50, we'll say 15. I'm paying 50 cents for a 2-point vertical. That is a much better trade. So, now what about some other ideas? All right, here's the cheap way to set up a trade. And it's called the earnings fly. And this is what I think is the best way to trade. So a lot of times those way out of the money options get overly bought. And I'm going to show you in Facebook. All right, so what can I do? I buy something close to money. I sell something that's junky out of the money. Takes advantage of that weird way out of the money pressure. All right, so what will happen is silly traders bid up those way out of the money options. Sell those to the dumbest buyer and then buy stuff around it. And this is the way skew can look around earnings. You know, the yellow, you can kind of see the difference there. The Fed has earnings, the blue does not. You see the problem? This is what it should normally look like. All right, so let's take a look at how I might set up one of these earnings flies. So here's you guys want to do Apple or Facebook? What do you want to look at? Well, because those get way overbought. The out-of-money junk gets way overbought. All right, you guys want to look at Apple. All right, they have earnings this week. All right. We'll look at Facebook and chat tomorrow, Trevor. So you can see, take a look at Apple. Calls. Take a look at this junk. The higher in price I go, the more expensive these options get. All right, so Apple, they think, it's trading 166.72. The straddle is about, 340 and 405. So it's about 750 minus kind of the 80 cents. So they're looking for about a $7 move. So anything outside of that $7 move is garbage. So I can buy, look at this, the 177s and the 175s. The 77s in particular. The 177.5s are by far, are interesting. Look at the 170s. So what I want to do is I'm looking for that $7 move. So I want something less than 175. So I would set up my trade probably at the 172.5 strike. I would sell the 180s. And I'd buy the 170.5s. I've got a long option that is inside the expected move. And I'm selling stuff that's twice the distance. So this is a 2 standard deviation move. And for selling a 2 standard deviation move, my cost of owning that long exposure gets cut in about half. So would I rather own the 172.5 calls for $1.54? Or would I rather have 7.5 points of exposure above 172.5 for 85 cents? What's more likely to win? It's a no-brainer, right? This butterfly is a million times better than owning the calls. Now, is there a scenario where the calls can outperform? Yes. But it's highly unlikely. And if you do 100 of these flies versus buying 100 calls, 100 trades of buying the calls, this fly is going to kick the bananas out of the calls. Now, on the downside, because Apple's gone too far too fast, let's just say, same thing. I buy the 160s. Sell the 152 halves after earnings. Or, heck, if it makes a move before earnings. On the downside, and here's another way that I can tell something's wrong. My put fly is cheaper than my call fly. That's rare. And 70 cents for this sucker. Excuse me, puts are cheaper than calls, which is odd. If I'm unsure of the direction, I'd probably not do a trade. You guys know my approach. Generally speaking, I'm a bigger believer in trading before earnings, taking everything off, and then trading after earnings. But if you're going to trade earnings, do it the right way, and these are the ways that I would trade it. So now, what about long-term buys? Earnings can be an excellent way to get into a stock that you like. And that is because this is from today that I was just looking at. That is from today. So, and if I'm trying to get into a stock, this is the one way that I will use earnings. I'll use a risk reversal. So let's say I like John Deere. And John Deere is a name that's in my John Deere is a name that is in my weekly wheel. So take a look. John Deere at this point was trading 132.30. This is from last Thursday. All right, so I can sell the 115 put at 350. That's $17 out of the money. $18 out of the money. Well, the same distance to that call. So the call, the 150 call, that's also about $17 out of the money, is $3.20. So what does that mean? Well, what if I sell the 115 put at 350 and buy the 150 call for 320? What do I get? I get a 30 cents in my pocket. And if John Deere does nothing, stays in a range, I keep my credit. If it rallies, I get ownership of the stock, and if it falls, I get ownership of the stock. This is a great way to set up a long-term play around earnings being up, around increased earnings, increased vol and earnings. I like setting up these trades to get into a stock I really want to own, regardless of earnings. Right before earnings can be a great time to set up a trade like this. because the implied volatility is so much higher. It's a good long-term play. So again, the best simple trade is my little butterfly. And I already kind of walked you through that one. All right. So now when I'm setting up these flies, let me give you kind of the rule. I want to, if I can, get 10 to 1 or 9 to 1 risk return. There's that Facebook trade. This was last week. So this was when Facebook was 170. And they were looking for about an $8 move. Well, what if I did these 77.5, 85, 92.5? How did that pay off? For the risk reversal, what if you do not want the stock? Then don't do it. I wouldn't do it if I didn't want the stock. So how is that trade looking that I pointed out? 77.5, 85, 92.5. This is even before earnings. This is just setting that up. Well, I think I did pretty well on my trade. My 77s are worth 560, my 85s are worth 230, and my 92s are worth 60. Not bad, right? I'd be out of this already. If I will look at a Facebook trade here shortly, folks. Did I sell that? No, jeez. The risk reversal was where what I want to do is when volatility is high before earnings, I want to sell an out of the money put and buy an out of the money call that are equidistant apart in a stock that I want to get delivery on. And right before earnings, implied volatility tends to be really high and puts tend to get more expensive, so I can often get my best credit. So, potential Apple plays, we already spent a little time looking at that. Now that Apple has earnings, we'll spend a little more time. So now let's talk about vol premium. How many have heard these whole sell condors, buy double calendars, sell strangles around earnings? Do not do that. Do not. They don't work. They don't work. Yeah. They don't work. They're a waste. The risk reward on those is terrible. Like I said, generally speaking, I don't even trade into earnings at all. When I do, it's only when I am very, very certain about what I'm doing. I don't just throw crap at the fan to see where it lands. So, will I do, and if I am going to do something, I will do those little baby butterflies because they're low risk, high reward. That is how I can make money on earnings. Selling stuff into those is a losing proposition. All right. There's kind of the summary. Here's the offer, guys, and then I'll look at a couple of stocks. So we have our Easy VIX course coming up, and it's going to start next week. It's going to be a 4-part VIX class. It is included with Option Pit Live. You may try Option Pit Live for $17. After that, it is $97 a month. Here's what you're going to get. You're going to get a good hour of me every day. I'm going to give you 2 to 5 really good ideas to trade. Not always going to win, but I think we've got subscribers here. Most of them will tell you, generally speaking, I try to pay for the service every day. Now, you're saying, well, Mark, I don't trade. I don't have time to sit there and listen to you. Well, guess what? Every day, right after I'm done talking, I do a 3 to 5 minute video called Chat Wrap where I talk about my 3 best ideas. Now, we've got multiple newsletters coming out. You're going to get to pick one of those. The Vol Letter, the Weekly Wheel. We've got other ones coming. You're going to get to pick one of those. And like I said, a free Saturday class every month. We sell those at $197. So this is a $17 trial. Go to option-pit-live-special-17. It's right there. How can you lose, though? It's 17 bucks. That's like 2 cups of coffee at Starbucks.
Hi there, I'm Mark Sebastian, the founder of Implied.
And there's me again. When is my course on trading options after earnings? And how soon? Now, I did write that. I do have a course that I did, a little class that you can find on YouTube, Mike, that I did. But I do want to do something like longer. Do you like live vol much better than toss? Yes. I will send out the chat. And there's the link in the chat box. All right, so I will look at 2 stocks. We've already done Apple. I've already briefly taken a look at Facebook, but does anybody have any stocks they want to look at? Yeah, Mike, I got to get something longer for post-earnings. There's lots to do. When puts are cheaper than calls, does that indicate anything specific? That's usually a sign that the market's at a top. Well, Mel, we already did Microsoft. What strategies do I do on my daily ideas? All sorts of stuff. A lot of little calendars, long calls, long puts, call spreads, butterflies, really you name it. I usually have like kind of one really easy one and then a couple of more complex ones. But we've been doing these SPX trades that have been killing it. Do you recommend ratio calendars before earnings to catch the IV pop? No. We're going to be phasing out the pit report. Can I look at race? Oh, race sounds fun. Using the SPX, probably going to keep going higher. But tax reform, I think, matters. So I'll look at race. That one's really interesting. Ferrari, I love it. And then we had a request for Tesla. Microsoft, I actually did do a trade in Microsoft after earnings that we set up. We did it in December. So we looked at volatility in Microsoft and we said, boy, I feel like they've oversold it. So I said, boy, this looks like it's too cheap. So we bought a straddle at the 84 strike. And you see, volatility was too cheap. We did the December 1st straddle. I think it's up a little bit, not very much, but it's up a little bit. We also did something similar in Google. We did the 1045 straddle. I don't know if this one's up or not. Let me take a look. I paid $35 for it, $35.40, and it's currently $36.70. So you can see that trades up a little bit, not bad. I haven't traded in book in years. What book do you recommend for all the terms you use? Sheldon Natenberg's book is the best book. Or we've got some stuff that'll get you up to speed. We've got our boot camp that's really good, and we have a bunch of other things like that. How fast will I be bottom? Usually within 2 days. So we're usually setting up to trade by Monday. You know, if earnings were Friday or Thursday night, we'll usually be in a trade by Monday. So let me look at race. Ferrari, I love it. They are looking for about a $6 move. About 5%, a little more than 5%. And that vol is not cheap. Let's see where it's been historically. It is right about where it is normally trading. And it's not cheap for the last 4 quarters. Or expensive. Well, let's see what's $6 out of the money. Well, you can see somebody was listening to me, because look what they bought. 117, 122. They bought the last option that is out of the money. So what do you notice about the 122s? What do you notice about these implied vols? Take a look. I'm going to show you something here, and this should maybe give you an idea on how to trade it. Well, a lot of volume, but take a look here. Here's 10%. Take a look. That's the 122 calls. Where was all that order flow? The 122s. And what's the most expensive option on the board? The 122s. So what does that tell me? I can probably sell this to set up my trade. So what would I do? I would be a buyer of like the 120, the 119, 122 call spread. I can probably get that done for less than $1. That is not bad. And then I'll look up here to see if there's anything else expensive. I'll sell the 125s, and I'll buy the 128s. So this is going to look a lot like a butterfly. This is going to act a lot like a butterfly, and it's going to cost you 60 cents. This is big. This kind of is looking at how it's going to move right now based on order flow. Would we have less IV collapse if one long strike is in the money? Yes. I like the way that sets up in race. 60 cents. I'm risking 60 to make $3 below 125. I'll take it. AbbVie already reported, Jim. SQ, is that square? You know, we had everybody probably wants me to look at Tesla, right? No, it was a balanced fly. It was just broken. It was just broken. It was split strike. Tesla. Now, you guys know my problem with trading with Tesla, right? Why I don't trade it. Yeah, you can. You can distribute the fly body if you want to widen things out. You absolutely can. So, I hate Elon Musk and Tesla. I think he's done a couple of good things, but I think, how am I computing the payoff? I'm using my head. If I pay 60 cents and the strikes are $3 wide, then I'm betting 60 to make $3. I'm going to get 4 to 1, right? $3 minus 60 cents is 240. 240 divided by 60, 4 to 1. All right, so Tesla, I'll take a look. They do have earnings. I have too much emotional. You're taking the difference in strikes. Yep, that's exactly right. They're looking for a $23 move. I would go out on a limb and say that's probably not big enough. You look at all these layoffs they've had, it's right at the 200-day moving average. I think they're setting up for a big move. Don't you? And all these hot stocks have been that way. Knowing them, they'll probably beat all the expectations. I don't feel like they will. Production's been awful. And the volatility is pretty high. For an earnings cycle, this is the highest vol's been for an earnings cycle all year. And in fact, the last time vol was this high in an earnings cycle was February of 2016, when when stuff was screwed up. So I would play it. I think you got to play it to move. I know I would. And, downside curvature is pretty flat. So here's the problem. I hate the stock on a personal level, so I would do a bearish spread. The 300s are cheap. I would do the 300, 277. So that's 22.5. 245. Bear fly. That's 22. That's a 10 to 1 payout. That's not bad. Yes, I will send out a recording. Sell, Mortimer, sell. So there's the 220. There's my trade. All right, guys. It's 5 o'clock. I went a little longer than I was planning. Got a bunch of your questions in. Everybody, sign up for this. If you've not tried out our services, we've changed it a lot, or you have, but you have not tried it in the last 6 months. It has changed. It is a lot easier to follow. And yes, Jerome, I will be at the Las Vegas Traders Expo. I'll have my new book. I'll have a copy for you. I forget, don't you have kind of a sweet car, Jerome? I'm trying to remember. I thought you had a nice one because you gave me a lift when I was in San Jose. All right. When we are overall bearish on a stock, oh, that's right. Yeah, it was nice. It was nice. You gave me a lift. The SLK, that's right. Yeah, Mike, I don't know that if you're bearish and you do it that way, and you're right more often than not, if you're right 50% of the time and you do that trade, you should win. The Expo in Vegas starts on Thursday. Have I done an earnings class before? Yes, I've done. I believe we have. I would not. I think flies both ways kind of silly. I don't really like trading earnings just for a move. I've got to play direction. All right, guys. I'll let everybody run. I'm looking forward to seeing you too, Jerome. It's been too long. I will talk to you guys soon.